Welcome to the Value Investor TV podcast. This is the podcast that helps you grow your wealth and become financially independent. My name is Beko and my partner, Hari.
Hello.
All right. Welcome, everybody. This is our Value Investor podcast. I was going to say the number there, but I forgot which number of episode we were on.
It's a lot.
Anyway, welcome everybody. We are going to talk about the recent how do you say this? Tech bubble or tech boom?
Yeah, surge in price.
Surge in price, and also rapidly falling in price too. So this like a quick spike up and down. What is it? You know, what was behind that? I'm sure some of you have read about SoftBank involvement in this. But in this episode, we're going to just quickly run through exactly what happened and sort of debunk some of this stuff. All right. So, Hari, you've done some reading into this. What happened?
Yeah. So what we're seeing is we have kind of changed the price to get into investing, right? So you look at companies like Robinhood, they are offering essentially no commission investment and trading. And Charles Schwab is, or I guess they're called Schwab now, offering similar things. So you can essentially buy stocks without having to pay equity contract, for the equity commission. But we've also seen this in the options market. So there's a lot of people who are in the retail space. So when I say retail space, these are non-institutional investors. These are the regular people like you and me, who are able to now buy equity transactions. So Schwab used to charge $5 per contract for an option, and they eliminated that fee, and they just charge I think it's like 65 cents or something very small per 100 shares. And so what that has done is essentially allowed people to invest. I should not say invest, speculate on the movement of stocks. Trade their way to making money. And especially with COVID, a lot of people have now, have become quote unquote amateur options traders. So what we're seeing is a lot of institutional sellers have positions in Apple or Amazon. We'll use Apple for this example because it's pretty well documented that it's occurring there. And what is happening is people will say the institutional will sell a contract for a call option, which allows the person who holds the contract, the retail investor, the right, but not the obligation to buy that stock when it hits a certain price. So let's say Apple is at $120 and they write a contract for $125. So what happens is the institutional investor gets cash from the retail investor, as a result of this call contract, right? And so if the price achieves the strike price, the $125, then the retail investor may buy the shares from the institutional investor. Well, what is happening is the price has gone up because of these, of the contracts and the volume and so forth, that if it hits that $125, the institutional investor doesn't have control over it. They have to give it over if the other party asks for the shares. So what ends up happening is the retail investor is driving the institutional investor to buy more shares because they have to maintain those shares in their portfolio, because whatever gets called away, whatever they have to sell, is taken out of their portfolio. So essentially what they're doing is they're buying more shares. That's driving up the price. And then they're repeating this process, which is creating a feedback loop. And essentially what it's done is allowed, the options market is relatively stable in the institutional side, but on the retail side, you've seen a lot of people come in that weren't there before. So this feedback loop is going on and on and on. And then a few weeks ago, or 2 weeks ago at this point, it all reversed itself very rapidly. And what happened was the retail investor was not, interested anymore. these funds were actually buying these shares, and then they had to dump them because they were not getting called away as expected. And so you saw a huge drop in the price all of a sudden. So, we've all been trying to look at this and say, scratching our head and saying, Tesla is at 100 or 1,000 PE, and these crazy valuations that we're getting for these businesses. Why is that happening? Well, it's happening because of largely mechanical parts of the trading process, right? This is somebody's selling calls, and that is allowing these things to occur. So, what does that all mean for us, right? As investors, right? I think it's a confirmation that options are a very dangerous kind of investment, right? That if you're using, I'm sorry, not investment, but speculation, that if you're using these as a, there are options that are things that you can do from an investment standpoint that are actually valuable, and I'll explain those here in a minute. But Warren Buffett called options the weapons of mass financial destruction for this reason, right? That this sudden change can occur at any time, and you have no idea, and you may not even be paying attention when it happens, and you've lost, a lot of money, right? And institutionals are doing this day in and day out, but the retail investor may not be paying attention from day to day, and that's where they get hurt, right? And that's why you want to buy undervalued businesses, because that doesn't happen.
Mm-hmm. Just one thing, just to recap what you said there, which I think is pretty fascinating stuff. I mean, the options market is sort of, kind of the underbelly of stock price sort of manipulation, and I mean, you can make a lot of money there. You can also lose a ton of money there. It's a dangerous territory. You got to know what you're doing. But just to quickly summarize what you said there, so what happens is the initial trigger of all of this is the call option.
Yep.
You and me, we pull money together, or me and myself, we buy option for that 125 contract. You buy that, and then the institutionals on the other side of it actually has to have that, because if the stock price actually hits that, I want to exercise that right to purchase that option, or exercise that option, right?
Yep.
And and they must have it. Therefore, they need to buy that stock, buy that equity,
right?
For me to get that from them. And so their act of buying stocks to service that contract increases the stock price, and then more people will jump because the stock price is rising to sign up for another call option at a higher price. That it's a positive loop, feedback cycle where you buy more contract, and then institutionals have to actually buy the equity itself to service that contract, and then that act itself raises the price, and then it happens all over again. And then same thing can happen on the other direction too, like Ari was mentioning. Just wanted to recap there.
Yeah, and so we've talked about options, and we want to be fair to them, that there is actually a legitimate thing for value investors in order to purchase options. Why would you ever do it, right? So imagine that you had a holding of some stock, and you are it's trading at $50 a share. You would be happy if you sold it at $80 a share, right? That's the fair value. If you sold it at $80, you'd be fine. So you can sell an option to someone and make a small amount of money per 100 shares. You sign some contract that says that's 10 cents per 100 shares, right? Or 10 cents per share up to 100 shares. So that nets you $10, right? So what you could theoretically do is sell your call options, and if the shares get called away, you still win. And if you don't, then you pocket the call premium that they have to pay you, right? So this is something that other value investors have done for many years, and it allows you to kind of benefit from this because you're just selling these options. I know people who do that where they hold shares in a company, and then they'll sell these short-term options for like a week expiration. So if the stock price doesn't rise above that price, then they just pocket the difference, and then they just repeat. every week. And so this can be a fairly profitable way it's basically creating a dividend from the asset that you own, right? And the limitation is that if your option is called away, you're only doing so at a price that you would be comfortable with parting with.
Yeah. So in this case, just going back to that example, you would be that institutional, quote unquote. You would be the ones
Right.
who are actually writing the contract, and selling the option, and then the counterparty would buy the option contract, and then when they exercise, you have to actually sell your stock.
Right.
And so from that standpoint, it fits in nicely with value investing, because your thesis is that the stuff that you're buying is going to go up at some point, and it's going to be overvalued at some price threshold. And
Right.
you can sell your options at that price threshold at some time equals 6 months or 7 months or whatever.
Yep.
Yeah. So makes sense. So moving on from that, in terms of the stock market bubble and where things are, companies hitting 1,000 PE, and for those people who think they missed out on this ride, what do you have to say about that?
So I would say that being patient is extremely important, right? You don't want to buy companies just because you have money, right? I would say if you have cash available and you can't find a business to invest in, then you sit on the cash until you can. And I would say that the patience and the waiting is very difficult. It's human nature to want to invest, but or to put your money to use and say, if I'm not doing anything with it, then I'm losing out. But my argument to be right now is we have not seen the full fallout of the COVID stuff. There is definitely the possibility that the options, that options open up again for you, not options for the stock, but options for, as in stock prices come down. Yeah, opportunities arise, I should say, that allow you to buy into these. And, the best way to be, to buy into these is having, keeping your mind open to that. And, you may have missed out on March, but I think it should have been a lesson to everyone who watched it and said there were companies that were cheap enough to purchase, but you failed to purchase because you were looking at, it's going to go down further, right? And that is a hard game to play because you think you're catching a falling knife, but really what you're doing is looking for an absolute threshold, that margin of safety price, and then buying under that.
Yeah, it's a good point. All right, so that sort of wraps up this episode. We looked at the kind of the mechanism of options and why it influences the stock price. So I hope that was helpful to you guys. And if you guys have questions about things like this, we also cover just any sort of questions that you guys have. We just don't we do more than just analyzing companies. So reach out to us with questions at info@valueinvestor.org, or leave us comments. We also look through there for any questions that you guys may have. Yeah,
and as we've been talking about the please visit our website valueinvestor.org, and we have a stock database that we manage, and we have screeners, and we have other tools on there to help you identify stocks, review them quickly. It has 30 years of financial data. We would love to hear from you about what features you would want us to add or change. And we hope that you can check it out and let us know what you think.
Awesome. All right. Thanks everyone for listening, and I hope you guys stay safe and happy value investing.
Thanks.
All right. Talk to you guys later. Bye.
Bye.